Hello and welcome to a CMS Forex daily video recap. I'm your fundamental market analyst, Nick Nassat. Today is Tuesday, August 3rd, 2010. Let's start today's report by taking a look at several U.S. releases that all came in weaker than expected. First up, we had data on personal incomes and spending, which showed that the second quarter finished on a fairly soft note. Both incomes and spending were flat in June when expectations had incomes rising 0.2% and spending up 0.1%. It was the first time in a year that incomes were not positive, and also we saw May's figures revised lower as well. The data implies that U.S. families have less money to spend and are cutting their purchases. We saw this deceleration in personal consumption in the second quarter GDP data already. The data does point out, however, that the savings rate at 6.4% rose to its highest level in a year. In a second release, pending home sales fell 2.6% in June following a large 29.9% decline in May. Expectations had been for a small rebound of 0.5% following that large previous month's drop. But instead, we continue to see weakness in the housing sector. Pending home sales are used as a leading indicator for home sales as they are measured at the signing of a contract to buy, even when the actual closing of the home purchase happens about a month or so later. In the third release, factory orders dropped 1.2% in June compared to the previous month following a downwardly revised fall of 1.8% in May. Expectations had been for a smaller 0.2% decrease. This report confirms the cooling we have seen recently in other manufacturing reading and shows that the pace of new orders and shipments, if measured by a yearly change, has topped off and is now actually moving downward. The worse than expected U.S. factory orders, an unexpected decline in pending home sales, along with the flat readings for the consumer spending and personal incomes pushed the dollar lower against the yen and the euro. Here we're taking a look at the dollar-yen pair, and we see that we tested this 85.66 level as our daily low, and New York afternoon trading, we were still near that low for the day. The dollar began its fall overnight against the yen on the discussion the Fed could consider a change in the management of its massive securities portfolio, effectively preventing a tightening in monetary policy. The data in the New York session also fed into talks that the Fed could consider pumping additional money into a U.S. economy that investors worry is slowing. Also, Japan's finance minister added some strength to the yen as he said he would in principle let market forces set the yen's exchange rate, suggesting the government isn't considering action to curb the yen's renewed strength to defend the nation's slowing export-driven economy. The euro-dollar pair, meanwhile, rose to a 4-month high as it tested the 1.3260 level. While we had the theme of weak U.S. data pressuring the dollar, the talk of the Fed moving to stop its portfolio from shrinking is a sign that policymakers are concerned about the economy and feel more needs to be done. The Wall Street Journal article reported discussion within the Fed centered on whether to use cash the Fed receives when its mortgage bond holdings mature to buy new mortgage or treasury bonds instead of allowing its portfolio to shrink gradually as it expected to do so in the months ahead. Any change only 4 months after the Fed ended its massive bond buying program would signal deepening concern about the economic outlook. If the Fed's forecast deteriorates significantly, it could also be a precursor to bigger efforts to pump money into the economy. Friday's non-farm payroll report, a key gauge of the health of the U.S. economy, will be closely watched, therefore, and if corporations are not hiring, it is a vote of no confidence and will bring the Fed into action, which can further weaken the U.S. dollar. If we go away from the US dollar and look at some other crosses, here we're looking at the euro-yen pair. We see that the yen was stronger against its rivals as it gained against the yen, stopping a 2-session rally in this pair. That implies that we had heavier risk aversion during today's session, despite the greenback not being able to actually manage to gain from that development. If we draw a Fibonacci retracement of our most recent upswing in the euro-yen pair, we see that we had paired about half of that move, though we rebounded from that level in later New York trading and look now to pair about 1/3 of this recent upswing. The Australian dollar Japanese yen pair, another one of our pairs very sensitive to risk sentiment. declined overnight after failing to reach its high from yesterday's session around 79.30, and we fell until we tested an upward sloping level of support. And we could see that now that we have a horizontal level of resistance and this upward sloping level of support, it creates a bit of a consolidation pattern. So it'll be interesting to monitor which way this pair breaks, either to the upside following a break of this resistance level, or to the downside if we breach this support trend line. Speaking of the Australian dollar, we did have the Reserve Bank of Australia decide on interest rates overnight, and it held rates at 4.5%. It was the third month in a row that rates have stayed at that level. The bank cited slower inflation and diminished financial risks abroad, which left officials with little need for any shift in policy. The statement also cited reduced pressure on house prices and an outlook for Australian growth that's about trend. In other words, the bank is now taking a wait-and-see approach, though economists believe at some point cash rates may need to go higher, but currently there's no pressing urgency. The weakest consumer price inflation in 3 years last quarter increased the RBA's scope to extend the rate pause after 6 increases since early October. The bank's governor, Glenn Stevens, said in today's statement, with growth likely to be close to trend, inflation close to target, and the global outlook remaining somewhat uncertain, the board judges this setting of monetary policy to be appropriate. If we look at the Australian dollar US dollar pair, we see that we did slide slightly following the RBA release as we retested this level of resistance around 0.9070 as support, and wound up actually regaining all these losses and testing the highs we had seen yesterday around just below 0.9150, as US equities managed to win back some of their earlier steeper losses and commodity prices rallied. So we'll see if in the upcoming overnight session we are able to move past this 0.9150 level of resistance. Taking a look at the upcoming fundamental docket, tonight we see the UK post a measure of shop prices, which is followed by Australia measures of its services sector, its trade balance, as well as a house price index. Overnight, the Eurozone will post its final version of its services PMI as well as retail sales, while the UK posts its services PMI. That is followed in the North American session with the US ADP employment change, a curtain opener for Friday's non-farm payroll report, with the ADP measuring private payroll growth, and at 10 a.m. we will get the ISM non-manufacturing PMI, a measure of the US services sector. And with that, we will wrap up today's video recap. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.